The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, as we closed out the week of the trade on Friday, some pressure in corn and soybean futures, only down moderately on the session, but still a quietly lower end of the week. I know the grain markets in particular have kind of been ebbing and flowing here this past week. Wheat futures tried to find a little green into the close Friday. Cattle also tried to hang on to some green on the screen ahead of the on-feed report. Outside markets taking it on the chin, though, again on Friday. Plenty to take a look at. Joining us now for a conversation, it is good to have him back with us, Jim Emter with Van On and Company. Jim, how are you, man? It's good to talk with you again.
Hey, doing good, Jesse. Just trying to stay warm, but it looks like we've got a change a coming, so we're welcoming that up here in the North Country.
Absolutely. I think everyone is welcoming a bit of a warming trend here for at least a few days as we get into this week ahead. That'll be nice for a lot of folks. And I wonder, thinking about trends, are we seeing a changing trend in this grain market? I'd love to just start and look at some of the technical picture with you here. I know I was tracking the 20-day moving averages in corn and soybeans on Friday, which we were playing with or broke through. But you even mentioned to me you're tracking a shorter kind of moving average right now. We had March options expiration Friday. There's a lot to look at here. So, I mean, technically in grains, are we starting to kind of run out of bull momentum, so to speak? Jim, what do you think?
Yeah, I think that's the case. So, we try to really break this apart into four pillars: the technical, the fundamental, the seasonal, and the money flow. So if we come in here and just break apart that technical picture first, anytime we start getting up into what we call a top bun of a market, 1.2 to 2 standard deviation away from linear regression. So we've got our downtrend line. We've got some progression up. We're into third price counts. We've got negative divergence. So that's a measure basically when we get new highs this last week, followed by a lower RSI. Those are just technical screaming indicators that say, hey, just be aware something could be in the works here. It might break, it might not, but just high awareness. So as you start to see this progression now, we're coming below the 9-day moving average, the 13. We're not quite down to the 20 yet, but you start to see these progressive natures that we're coming in there. We just got some certain guidelines that I just don't share on open airwaves, but there's a reason we start using the 13 when we're at a certain area, so we can catch this thing a little bit quicker, and we're coming below that today. And I really think when you couple it together and say, okay, technically we're starting to see some toppy action, does that mean it's a top for the season? No, I think people need to get away from this, oh, we've got a top, we've got a bottom, we've got this, we've got that, because again, the charts are going to gyrate. We've got a lot of moving parts right now, more than we've seen in some time. And the black swan event is really not a black swan anymore, because it feels like more often than not, something's coming around the corner that people aren't expecting. So we've got to kind of lean into this, and that's why the four pillars come back. We can look at it technically and say, hey, we've got 8, 9 of our technical processes starting to scream, hey, maybe toppy for a little bit, maybe a good setback, like the cattle had just seen, where you get a healthy pullback and then we try to cleanse up. I think that's what corn's going to try to do here is maybe tailor back a little bit, cause some break, pull back. You've got improvement in the Brazil planting condition. You've got seasonally where we tend to drop. So we start layering in some of these other pillars, and you say, okay, well, maybe the funds, maybe traders, maybe farmers just want to take a little break here. We got to $5 this week in March, May, and July, futures-wise, with basis levels okay in some parts of the nation, yet that's a pretty good cash price, and I think that's just the layer that corn's up against. But make no mistake, that doesn't mean the market's done long term. It's a healthy cleanse, Jesse, from our vantage point.
It just feels like it's maybe a little bit of exhaustion at $5 in March corn, and to your point, just kind of pulling back. We've probably seen some farmers selling here on old crop corn, people catching up on remaining sales and things of that nature. It just feels like we kind of got exhausted and just kind of taking a breather right now in this corn market.
And the other thing too, Jesse, is to get a move like this, we've got spreads. Look at the carry between March and May right now. Go look at basis trends where we're seeing a general widening as we get to these higher. They don't have the characteristics of the big bull market at this structure yet. Not saying they can't come down the road if we don't get 4 million acres increase to corn, if we have struggles planting at any point, if the drought comes in. Those are all scenarios that change the narrative very quickly. But at least for now, a pretty good opportunity has come in the old crop for producers to get back to profitability, get the balance sheet square, go to the banker and say, hey, look, I've sold some grain. I got some cash flow. I can pay off that operating line. Let's extend next year's. There's just a lot of layers here that I think, hey, this is a healthy time. This is why we call them a John Deere low type base, where we tend February, March, have payments coming due, cash is generated, and markets slip a little bit.
What about soybeans more specifically? I've had a lot of folks say they're way more concerned just about the technicals and the fundamentals in soy, especially with that big Brazilian crop coming online. And they've been more friendly corn. So I would guess, looking over at this soybean complex here, well, I won't guess. I'll just ask you. I mean, are you more concerned in the soy complex as a whole right now than corn, Jim?
Yeah, so I think it's a great question, Jesse. And I think what's unique about markets is you can turn on this in a lot of other places and hear a lot of different opinions. Let's put it to this. If soybeans get above 1074 off the May, that is important. That's above a 200-day moving average. You start to activate attentive nature on saying, hey, something fundamentally, structurally is changing. That's more bullish to a market. Until that happens, which we went up and tested a few weeks ago and failed, I would expect a pullback back down towards 1015, which puts us into another cylinder that we watch in regards to our technical analysis. And that would be more of an area where we can find support. So until we get above 1074, I'm thinking of for a pullback to 1015. And if we get the pullback to 1015, then I'm going to think about reposturing on maybe a little bit more friendly picture due to less acres in the soybean markets, maybe getting 3-4 months past this Brazil harvest, where we know then you're not dealing with that influx of production. So a lot of people ask me, hey, Jim, I see the acres story. When's the time frame to maybe be a little more friendly? And I think that's a valid question, especially if we get hot, dry this summer. That's 3-4 months down the road, though. So if you buy it now, burn out all this time value, you're just missing an opportunity or using capital you don't need to use. That's why we like framing up the breakout spot and then pull back target. And those are the numbers I'd throw out there right now, Jesse.
You mentioned acres, and I know that corn soybean ratio has definitely leaned to the corn side for new crop here for US. And I know we'll get the outlook for them this upcoming week from USDA. They'll give us their best guesstimate here early of what we're going to see. I guess as we shift the conversation to new crop corn and soybeans, and you think about the acre mix, and you mentioned weather, et cetera. I mean, what is on your mind when it comes to new crop corn and beans right now, Jim?
Yeah, so let's talk about it. I mean, the incentive there with an awesome crop insurance price during the month of February. I mean, if you'd have came back to December and told producers we're going to come in here and print 470 type price structure, they'd get pretty excited and say, hey, that would be great. And now we're here. So as I look to the base, I believe that corn market's winning the acres battle. I don't think that's it's talked about a lot in the industry. So, I mean, that's not an uncommon, conversation right now. The question is how much. In my opinion, if it's under 2 million acre, 2.5 million acre shift, that might be more friendly corn and a little bit more negative beans. Anything over that, as we start to get to the 3 to 4 favoring the corn million acres, now all of a sudden that gets more bearish corn, more friendly beans working into this next year. So we've done some studies back. If you look at that corn bean spread on a 2-to-1 ratio, corn to beans, right now we're at the third strongest price point we've been at in the last 20 years, favoring corn over soybeans on that 2-to-1 ratio. So a lot of people want to refer to it, hey, we're around $1. That's great, right? For corn? Yeah, it is, but let's put it back in perspective. How many times have we been here the last 20 years? And it's only 2 more times better than this current price structure favoring corn. So I think that warrants an acres move. And one of those years was 2007. And we ended up watching that spread go from an area like this to all of a sudden favoring beans the second half of the year by a major margin. So past performance not indicative of future results, but it just starts to get your attention when you start to see that.
It's one of those things that so much is going to change between now and when we roll the planters. I mean, it just kind of comes back to being nimble and looking at your break evens and just having a couple different plans, right, Jim?
Well, correct. And here's the one that gets me the most. If you're going to plant more corn because it's profitable now or it fits better, what are you doing about marketing it? I hear a lot of conversations of, hey, I'm going to go plant corn. It works. The crop insurance price is better. But if you have a good yield and crop insurance isn't going to kick in until 385, 390, there's a lot of gap there on dollars per acre that if you don't market it, corn drops, beans rally, you might be sitting here on a rotation saying, wow, I really missed that boat. And that's where we get concerned that farmers may find themselves 1 year, 2 years behind these trends is they make the move, they get caught in the emotion, then they don't do anything to protect it. And then all of a sudden they're sitting there looking. There's no question a drought this summer could impact both the corn market and bean market. But we saw last year how you can have a great corn yield, and I'd still be a little suspect that bean yield, or the bean yield's a little higher than I thought it would be based off what we had for conditions to finish out late July, August, and September. So to be determined, but Trump's tariffs are the equal component that make people hesitant to trade that corn bean spread right now, because if all of a sudden we get into a tariff battle with China and they say, you know what, we don't need your beans, we're going to cancel the last 15% of purchases, Jesse, you know how detrimental that'd be to futures price. And that's, I think, the limitation that allows people to come in with confidence on that bean to corn ratio spread. Again, that's going to change as we get into planting, get more certainty, and see where these tariffs go.
Jim Emter with Van On and Company joining us here today on Market Talk. And you bring up the tariff conversation, rightfully so. A lot of these external headlines impacting the markets, whether it's grains, livestock, etc. I know we saw stocks and equities down hard again on Friday. The crude oil market down as well. Wheat, though, tried to rally a little bit. And I'm curious your thoughts on this wheat market with all the external noise out there right now.
Yep.
I mean, how are you feeling about wheat being around $6 on the board?
Well, it's about time. I mean, you look to where corn went, you look to where beans went. I mean, wheat has been the laggard here on getting to the party. Now we've got wheat to the party, and the old saying goes, if you're going to have a big market, you want it led by wheat. And hey, we got wheat now joining the party, all but late. But let's come back and review why that is. These extreme cold temperatures all the way down to Texas over the last week, when prior to that you had 90 degrees. Hey, we got wheat maybe where you're not going to see a lot of winter kill, but at least there's some weather premium that came in as a result of that. Now we're going to take that weather premium potentially away as we warm back up again and realize wheat has 9 lives. The second thing here is this Russia-Ukraine. I mean, it's twisting and turning every which way. And we've heard this for 3 years, where we want to talk about Russia-Ukraine a little bit, and then it doesn't go anywhere, and then we let it fall by the wayside for 3 months. Then it catches a little attention. This feels like it's going to come to a headway pretty quick here, Jesse. And I think that, too, has traders kind of caught up into this, hey, maybe we need a little premium in there for that. And I think that's where we've gotten to. Now, the tough thing is the wheat market has gotten to, second price counts now. So as we look to some of those extension goals, it's like, okay, do we really have enough to get to these third and rare fourth price counts? Or is this an area that we can begin to fail or fall into? And I'm a little concerned we ran into resistance for now, but over the next, let's just call it 3 to 6 weeks, I think we've got 50 cents risk down, $1.50 up, and that's a flip a coin as to which one. I just think if we come down, we're going to find buyers around 50 cents lower. If we break out here, it might be $1.50 before we stop. So the dynamics, Jesse, I will lay out in that. Again, that's just my opinion, our opinion. But I think you just got to try to work within the means of that and be ready to defend if that breakout happens, especially if you're marketing here. But the one thing we've seen as we've gotten this rally, basis levels are widening out just like they did in corn and soybeans. So if you're a marketer here, you've got to put the whole cash picture together and say, all right, if I am bullish and we go higher, basis widens out, maybe I'm better making the sales and finding a way to re-own it than watching the basis eat up a good part of the rally from this point forward.
Talk to me about the protein sector a little bit here before we close out today. Cattle futures, again, trying to rebound a bit into the weekend ahead of an on-feed report. You had a hog market that tried to find a little bit of technical footing as well. I guess there's been a lot of dynamics going on here in the proteins this past week. What's your view as you look over at cattle and hogs, Jim?
I think to have a healthy market, you've got to have the packer in an okay spot. When you've got a packer here in the weeks prior losing $200, $250 a head brought through to slaughter, something had to change. And that change is shortening the hours of operation to 32 hours. That change is shutting down plants for a few days here or there. There was even a fire at one of the locations. I was on the speaking circuit in January, and I just said, this is usually the time where you need a story to get the packer back in control. We get this pullback, and if you want to know what corn pullback could look like, it could look a lot like cattle, where we get this retracement down, we find a base support, and then we see what we've got from there. But coming back to the cattle, we need the cash to hold here now. We're starting to see that cash decline. You've seen the cutout values come down. Again, those are all the layers that have allowed this cattle market to make a healthy cleanse. I think this is an area, Jesse, from here down about $4, we're going to find our support, and we're going to start to come back out of this, because there's no question we've got tight supplies on the production side. We got a cattle on feed report this afternoon that we don't have as of this recording, but we'll digest that a little bit. But the economy scale is the other one. When I see the Dow down 750 points, then I'm going to say, okay, let's wait a minute. we need to see that economy stay to see that demand sector there. And that's going to be the key on cattle, whether we can bottom in the next $4 or not. But that's my intent based off what we know today. I'm going to watch that outside economic pillar for any changes there. On the hog market, we had the big run up, we had the breakdown. Now we're kind of into this area here where we need to hold support. Otherwise, we start to buck the trend. But still, we've got higher highs, higher lows off the chart. We may have a nice pullback right now. But from a hog sector, if we can get that cash going, get exports back on track. I mean, exports down 27% versus the 4-week average today. Hey, we just got a little bad news for the hog market that allowed this market to get back to the bottom end of the chart, but still in an uptrending pattern. If we start violating those previous lows, that's where we've got a problem.
Awesome analysis as always, Jim. Final thoughts. What would you leave folks with here today or reiterate to them as we close it out?
Stay defensive. Just don't get caught into one story or the other. Don't get caught bullish or bearish. Don't get caught trying to forecast the top or bottom. Be in here, look at your break-even analysis. Be ready with price targets. And when we start changing trends, find somebody that's a good technician out there that's going to start bringing some value as to when these trends change, because there's going to be a lot of stories coming up, and you've got to have those disciplines to try to protect your farm's break even.
Absolutely. If folks want to reach out to you and the great team you got there at Van Ahn & Company and talk about their marketing plan and their strategies and more, I know a few ways to get in touch. How can folks reach you?
Yeah, first, give us a call, 800-648-5494. You're going to get into the office, and you've got a lot of great staff that you can talk to here that can help you along the way. Second option, just start on the web, www.vanahncco.com. You can get on that website, learn a little bit more about us, and then activate a call after that. 2 great ways to find out more about Van Ahn & Company.
Jim Emter, Van Ahn & Company. Always good to hear from you, my friend. Thanks for joining us on Market Talk, and we'll look forward to having you back on the show again real soon. Thanks so much.
Thanks, Jesse. Take care.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.